Good morning. Thank you for joining today's daily webinar. Today's topic is why is a Mega Backdoor Roth better than a Backdoor Roth IRA? Have you ever felt limited by contribution caps on your Roth IRA? Or maybe you've heard about the Backdoor Roth IRA strategy, but wondered if there is a smarter, bigger way to supercharge your tax-free retirement savings? Well, you are in the right place. Today, we are giving you a sneak peek at one of the most powerful yet overlooked retirement strategies, the Mega Backdoor Roth, also known as the Mega Backdoor Roth Solo 401k or Mega Backdoor Roth 401k. The truth is, most high earners get boxed out of direct Roth IRA contributions because of income limits. That's where the standard back Roth IRA comes in. It's a workaround that lets you put in about $7,000 a year if you're under 50 or $8,000 if you are 50 or older for tax year 2025. Sounds good, right? Well, here's the problem. Those limits are tiny compared to what is possible. If you are self-employed or have access to the right 401k plan, the backdoor Roth IRA starts to look like pocket change. So enter the Mega Backdoor Roth 401k or Mega Backdoor Roth Solo 401k. With this strategy, you are not talking about just $7,000 or $8,000 per year. You could potentially funnel tens of thousands of dollars, up to $70,000, for example, or more for tax year 2025, utilizing the Mega Backdoor Roth 401k. All of that growth is tax-free. So imagine what that could mean over the next 10, 20, or even 30 years. So again, thank you for joining today's daily webinar. As always, please type questions you have. It doesn't have to be specific to today's topic, which is why is a Mega Backdoor Roth better than a Backdoor Roth IRA? When we talk about Mega Backdoor Roth, we're talking about a Mega Backdoor Roth Solo 401k or Mega Backdoor Roth 401k, for example. So if you have any questions, go ahead and type them over and we'll pause and answer those questions as they come in. They don't have to be specific to today's topic. They can be surrounding even self-directed IRAs, traditional 401ks, the business financing, rollover business startup 401k, as well as any aspects surrounding self-directed solo 401k plans. We are well versed on all these topics. We've been in business for over 15 years, so we've pretty much seen everything under the sun. Okay, also please like today's video. Please also subscribe to our YouTube channel so that you receive notifications when we go live. Also, you can visit our YouTube channel where we have a large video catalog. We have over 900 videos there. You can also visit our community where we have over 30,000 members. Individuals are always posting forum posts. If you're a financial professional, you can also post a guest blog post and link it back to your company's website so that you get your website presented and your services to our entire community. We also have our artificial intelligence section, and you can get to that section by going to www.solo401k.ai. Okay, again, it looks like you've got some questions here, but today's topic is why is a Mega Backdoor Roth better than a Backdoor Roth IRA? Let's take a look at some of these questions here, and then we'll be able to come back here and get started with today's topic. Okay, let's see. We've got a question here. We got a comment here from Wayne. just was talking to my wife about this 2 days ago. Oh, that's great. I'm glad you have a chance to attend today's live webinar. We'll be going live again here in a couple hours. So if you don't get a chance to ask your questions now, you can subscribe to our channel and you'll receive a notification when we go live again. And let's take a look at the next question here. I have a question about where to report solo 401k contributions on my taxes. Okay, great. I'm also going to share a link from our website where we've got a step-by-step procedure on how to report contributions on both your personal tax return and or business tax return. Let me pull up that link here and share that with you. We have illustrations there that gives you line by line numbers as to where to report those contributions. Here's the link. I'll share that with you here briefly. There's the link to that specific page on our website. If you go to that page, we break down how to report contributions for each entity type, from an S corporation to a sole proprietorship and partnership, for example, because they're reported based on the type of tax return filed for your self-employed business, as well as the type of contribution, whether pre-tax, Roth, or voluntary after tax. Let's see here. So take a look at that link. Looks like we've got another question here. For someone in a high tax bracket, is there a suggested strategy for pre-tax versus post-tax contributions? Great question. I mean, at the end of the day, it comes down to picking your poison. That is, do you want to pay taxes to the IRS now? Or do you want to delay paying taxes to the IRS by paying taxes later when you take distributions? What does that mean exactly? Well, when you make Roth solo 401k contributions, or even voluntary after-tax solo 401k contributions, and then convert them to the Roth IRA or the Roth solo 401k, those contributions are made with after-tax money, meaning that you're not going to be able to get a tax deduction for the year when you make Roth solo 401k or even Roth IRA contributions or voluntary after-tax solo 401k contributions as part of the Mega Backdoor Roth solo 401k strategy. Whereas when you make pre-tax contributions, that's going to reduce your taxable income for the year. But the trade-off is that while they go into the plan as pre-tax solo 401k contributions and you get a tax deduction now, all the gains on those pre-tax solo 401k funds will grow tax deferred. However, you're going to have to pay taxes on all of those pre-tax solo 401k funds when you begin to make distributions. So as a result, we find that a lot of clients do a mixture. They'll make some pre-tax contributions so that they can reduce part of their taxable income for the year. And then they'll make some Roth 401k contributions and then some voluntary after-tax solo 401k contributions. Also, we find that some clients will make their entire contribution to the solo 401k as pre-tax in 1 year when they're in a high tax bracket. And then in later years, when they're in a lower tax bracket, they'll turn around and convert those pre-tax solo 401k funds to the Roth solo 401k through what's called an in-plan conversion. When you convert pre-tax funds from the solo 401k to the Roth solo 401k, that's a taxable conversion. So clients typically like to do that in years that they're in a lower tax bracket. Hopefully that gives you some type of information to chew on. Okay, let's see here. Oh, what other questions we have here? We've got here a question here from, where are we at here? Looks like Jason just signed up. That's great. Asking about electronic signatures. No, it's going to be best to sign those signature pages with the black or blue pen. So the old-fashioned way. Anytime you're signing legal plan documents, in this case, we're talking about retirement trust documents, you want to really sign those with the black or blue pen, and you want to make sure that you upload the signature pages that have the black or blue pen signature. And oftentimes, when we go to help you open up the bank accounts and brokerage accounts, that institution is going to be very picky. They're going to want to have a black or blue pen signature. So it's always best, the rule of thumb, to sign legal documents with the black or blue pen. Great question. Okay, what other questions do we have here? Let's see here. Again, go ahead and type over your questions and we'll be happy to go over those during today's daily webinar. I'm a solo 401k. I was a sole proprietor. This year I formed an LLC. Do you help transition or roll over old solo 401k to be sure my new company? So if you have an existing solo 401k plan with an outside organization and you want to move that solo 401k to our institution, that's called a restatement. And when we restate a plan, we'll make sure to draft the restated plan documents listing your new self-employed business. And then we'll help you to pick up and move that existing plan over to this new plan. And that will not be considered a taxable event nor a reportable event because you're simply picking up one existing solo 401k plan and moving it to another solo 401k plan. Therefore, it does not trigger a Form 1099-R, which is used when you transfer a solo 401k to an IRA, for example, or if you take a distribution, nor will it trigger a final Form 5500 Easy, which applies when you formally close a plan with the government. Okay, we'll come back and monitor for questions as they come in. For now, let's get back to our presentation for today, which is why is a Mega Backdoor Roth better than a Backdoor Roth IRA? Give me a moment here and we'll get to that. So this is a good topic that we get lots of questions on. So we're going to discuss the following key differences between a Backdoor Roth IRA and a Mega Backdoor Roth. Also, how much you could contribute each year, who qualifies, and common pitfalls, and why the Mega Backdoor Roth is a powerful strategy. So let's introduce the Mega Backdoor Roth 401k, aka Mega Backdoor Roth Solo 401k. You can contribute as much as $70,000 for tax year 2025, which is the overall limit, to the voluntary after-tax solo 401k bucket inside the plan and then convert it to the Roth IRA or the Roth solo 401k. So that's a huge amount that you can utilize for the Mega Backdoor Roth strategy. And that's going to result once that voluntary after-tax solo 401k contribution has been converted to the to the Roth IRA or the Roth solo 401k, those funds are going to grow tax-free. So this is a game changer for self-employed individuals. That is the Mega Backdoor Roth. Now let's understand the solo 401k basics. So in order to qualify for a solo 401k, you have to be self-employed, hence the name solo. Solo means only or one. So as long as you're an owner-only business, then you can open a solo 401k plan, provided that business does not employ any non-owner full-time W-2 employees who work 1,000 hours or more in your business. There's a spousal exception where your spouse can also participate in the same solo 401k if he or she is working in the business. If he or she works 1,000 hours or more, then you can still have a solo 401k plan because that's your spouse. And again, your spouse can even participate in the solo 401k plan. He or she doesn't have to. That's not going to preclude you from opening and making contributions because both spouses are not required to make contributions to the plan. In other words, one spouse can contribute while the other one does not. So again, a solo 401k is designed specifically for owner-only businesses. So this is what makes it the ideal retirement vehicle for those who are self-employed and they want to utilize the Mega Backdoor Roth 401k, aka solo 401k strategy, and why it makes it better than the Backdoor Roth IRA. Now, the Backdoor Roth IRA process is obviously different than the Mega Backdoor Roth solo 401k process. With the Backdoor Roth IRA, you generally utilize that strategy if you make it more than your modified adjusted gross income allows for the year. So if your modified adjusted gross income for the year is over a certain dollar amount, then you cannot make Roth IRA contributions. And that's why individuals utilize the Backdoor Roth IRA. And they do that by opening up what's referred to as a non-deductible IRA. You then make a contribution to that non-deductible IRA. So for 2025, that overall contribution limit to an IRA is $7,000 or $8,000 if you're age 50 or older, because you would qualify for the catch-up. So you would make that after-tax IRA contribution to that non-deductible IRA, and then you would convert that after-tax IRA to the Roth IRA. However, there's a pro rata rule that applies to non-deductible IRAs. And keep in mind that the pro rata rule does not apply to the Backdoor Roth solo 401k. That's one of the major differences between a Backdoor Roth IRA and the Mega Backdoor Roth solo 401k strategy. And we're going to talk more about that pro rata rule a little bit later as it relates to a solo 401k. But sticking with the Backdoor Roth IRA. So again, if your modified adjusted gross income is over a certain dollar limit, then you cannot make a Roth IRA contribution. And therefore, you utilize the Mega Backdoor Roth, the Backdoor Roth IRA strategy, where you make a contribution to a non-deductible IRA, and then you convert that to the Roth IRA. However, if you have other IRAs, whether we're talking about traditional IRAs, SEP IRAs, or simple IRAs, you're going to have to aggregate not only those IRAs, but also that non-deductible IRA when making that conversion from the non-deductible IRA to the Roth IRA because of the pro rata rules. So as a result, it's not as advantageous, because what that means is you're going to have to convert some of your SEP IRA funds, some of your simple IRA funds, some of your traditional IRA funds in order to also convert that after-tax IRA contribution that you made. Now, we've done other webinars where you can actually isolate that non-deductible IRA, but we're not going to talk about that right now. But we have our video catalog where we've covered that topic. But at a high level, you can isolate that non-deductible IRA by transferring the gains and that non-deductible IRA to a solo 401k. So let's say the non-deductible IRA is worth $9,000. Let's say $7,000 of that is basis. In other words, the contribution amount. You can transfer the gains. So $2,000, those are pre-tax gains. You can transfer those to the pre-tax solo 401k if you're eligible for a solo 401k. And then the remaining balance of $7,000, that can get converted to the Roth IRA, and therefore you're not going to have to touch your traditional IRAs, SEP IRAs, or simple IRAs when processing that conversion. So that's how the Backdoor Roth IRA process works. It's not quite as straightforward as the Mega Backdoor Roth solo 401k strategy. We'll come back to this slide here in a moment. But with the Mega Backdoor Roth solo 401k, again, as long as you're self-employed, you can open up a solo 401k that allows for the Mega Backdoor Roth solo 401k strategy. And with the Mega Backdoor Roth solo 401k strategy, you can contribute as much as the overall limit for the year. So for tax year 2025, for example, the overall contribution limit to a solo 401k plan is $70,000. So you can choose to contribute that entire $70,000, provided you have enough net self-employment income from your business. You can choose to contribute that entire $70,000 to the voluntary after-tax solo 401k bucket, and then turn around and convert it to the Roth solo 401k. So this slide here, let's talk about this slide here, the one on the left. So this is an example of a one participant plan. So with the solo 401k plan, you can make various contribution types, and you are required to have separate holding accounts for each contribution type, because a solo 401k is a defined contribution plan. And as a result, you have to have not only separate holding accounts for each source of funds, but as this graph here on the right demonstrates, you have to have separate holding accounts for each participant. So let's look at the one participant plan. Let's say Joe is self-employed as a sole proprietorship or under his S corporation. It's only him in the business. So he opens a solo 401k. So his self-employed business is going to sponsor the solo 401k. And that solo 401k allows for these various contribution types: pre-tax, Roth, and voluntary after-tax. So it's not three separate solo 401k plans. It's one solo 401k plan that allows for these various contribution types. And as a result, when you want to make these type of contributions, you need to open up a separate holding account under that solo 401k plan to hold these contributions. Also, let's say you have a former employer 401k or a traditional IRA you want to transfer to the solo 401k. That would get transferred into the pre-tax solo 401k bucket. You can never transfer a Roth IRA to the Roth solo 401k. That's a Roth IRA restriction. Let's say you also have some gains in a non-deductible IRA. As I talked about earlier, you can transfer the gains and a non-deductible IRA, which are pre-tax funds. Those can be transferred as a direct rollover to the pre-tax solo 401k plan. So the voluntary after-tax solo 401k bucket is part of the Mega Backdoor Roth solo 401k strategy. So you would make that contribution into the voluntary after-tax solo 401k bucket, let's say $70,000, because you have enough net self-employment income. And then you would immediately convert that to the Roth IRA right away, or to the Roth solo 401k. So in this case, to the Roth solo 401k. This is the Roth solo 401k bucket. Again, you can also convert it to a Roth IRA. So you would open up a separate Roth IRA with Fidelity or some other institution, or if you have a Roth IRA already, you can convert the voluntary after-tax funds to that Roth IRA instead of the Roth solo 401k. So the Mega Backdoor Roth solo 401k strategy allows you to choose to convert the voluntary after-tax solo 401k contribution to the Roth solo 401k or to the Roth IRA. You get to choose. Okay, let's go back to the prior slides here. So we've been talking about the Mega Backdoor Roth solo 401k. Let's go back here and let's talk about the differences between the Backdoor Roth IRA and the Mega Backdoor Roth solo 401k. So with the Backdoor Roth IRA, you make a contribution to that IRA, and then you convert it to the Roth IRA. With the Mega Backdoor Roth solo 401k, you make the voluntary after-tax contribution to the solo 401k and then convert it to the Roth solo 401k or the Roth IRA. You have to make sure that if you want to utilize the Mega Backdoor Roth strategy, that you open a solo 401k plan with a provider whose plan allows for the Mega Backdoor Roth strategy, and my solo 401k financial is a plan that does. As a matter of fact, we oftentimes have clients over at Fidelity and Schwab who convert their existing plan from Schwab or Fidelity over to our plan so that they can utilize the Mega Backdoor Roth solo 401k strategy. So the Backdoor Roth IRA is more for high income earners who make over a certain dollar modified adjusted gross income amount, which does not allow them to make Roth IRA contributions. So they utilize the backdoor Roth IRA to be able to do the backdoor Roth IRA. From a contribution perspective, for both tax year 2024 and 2025, the maximum backdoor Roth IRA contribution limit is $7,000 or $8,000 if you're age 50 or older. Whereas with the solo 401k, it's actually $69,000 for tax year 2024, and it's $70,000 for tax year 2025. This whole 50 and over catch-up amount, that catch-up amount is just illustrating how you can make the how you can make the Roth solo 401k contribution catch-up amount, which is $7,500 for tax year 2024 as well as tax year 2025. You can never utilize that catch-up amount of $7,500 as part of the Mega Backdoor Roth solo 401k strategy. The maximum you can utilize as part of the Mega Backdoor Roth solo 401k strategy is the overall limit, which is $70,000 for tax year 2025 and $69,000 for tax year 2024. Catch-up solo 401k contributions can never be made to the voluntary after-tax solo 401k bucket. And as a matter of fact, this year in 2025 is the last year that you can make catch-up contributions to the to the pre-tax solo 401k. Going forward, starting January 1st of tax year 2026, all catch-up contributions to a solo 401k have to be deposited to the Roth solo 401k bucket. They will no longer be available to be made to the pre-tax solo 401k bucket. That's a new IRS regulation. It actually resulted from Secure Act 2.0, but it was just finalized by the IRS recently that now, starting January 1st of tax year 2026, all catch-up contributions, so the $7,500 catch-up contribution that applies to those who are age 50 or older, those are going to have to be made to the Roth solo 401k. Same rule applies to full-time employer 401ks. Let's say you have a full-time employer 401k and you work for the Home Depot and you participate in the Home Depot 401k. Starting effective January 1st of 2026, and if you're age 50 or older, the catch-up contribution amount, you will no longer be able to make it to the pre-tax 401k bucket. It's going to have to be made to the Roth 401k. So that's probably some good information to know ahead of time from a planning perspective. So let's keep talking about the backdoor Roth IRA versus the Mega Backdoor Roth solo 401k, the differences, the mechanics. So again, when you make a contribution to a IRA utilizing the backdoor Roth IRA, you make that either to a traditional IRA or to a separate IRA titled non-deductible IRA. Whereas with the solo 401k, you make the voluntary after-tax solo 401k contribution to the plan, but you're going to make it to the voluntary after-tax solo 401k bucket, aka bank or brokerage account under the plan, and then you're going to convert it to the Roth solo 401k or to a Roth IRA. So you don't open up an additional IRA. You open or you don't open up an additional solo 401k because the plan allows for those different contribution sources as we discussed earlier. Let's go back to our slides here. Give me a moment here, and then we're going to check for some more questions and go over those questions, and then we'll come back and continue with our presentation today. So, tax implications. So when you convert the non-deductible IRA funds to a Roth IRA, any gains that you convert to the Roth IRA from that after-tax IRA are going to be taxable, unless you utilize a solo 401k to isolate those gains in a non-deductible IRA, as I discussed earlier, where you transfer the gains in that IRA to the pre-tax solo 401k so that you isolate the basis and that non-deductible IRA, and then you can convert that basis in that non-deductible IRA to the Roth IRA. So with the after-tax, voluntary after-tax solo 401k bucket, you isolate those in the voluntary after-tax solo 401k bucket after you make that voluntary after-tax solo 401k contribution, and then you convert it right away so that there are limited gains. When the limited gains are also converted, you'll pay taxes on those small gains when they get converted to the Roth solo 401k bucket, but there's no pro rata rule that applies since they're going to be isolated in that voluntary after-tax solo 401k bucket. Okay, let's take a look at some questions here, and then we'll continue here with our presentation, which is why is a Mega Backdoor Roth solo 401k better than a Backdoor Roth IRA? Let's see here. Oh, we've got a question here. Can you go over how to open Fidelity accounts and how to handle the funds to get into the Mega Backdoor Roth? I'm not going to go over that right now because that's actually a whole presentation in itself. And we've done past webinars on that topic. But I'm going to share with you the information on how it works step by step. Give me a moment here. I'm going to share that with you and you can take a look at that. We've done a full presentation on that in the past. Give me a moment here while I dig that up. Give me a moment here. Here we go. I've got a really good webinar we did on this topic actually a couple months ago. There are videos, there's a webinar. Take a look at that link right there. I just shared that with you. But in a nutshell, you're going to make the contribution to the let me pull up my slide here. So again, if you utilize Fidelity for the brokerage accounts for a solo 401k from my solo 401k financial, we're going to help you open up 3 separate brokerage accounts at Fidelity under the plan. One is the pre-tax bucket. That's if you want to transfer IRAs, former employer funds, or make pre-tax contributions. The second one is the Roth solo 401k bucket, and the third one is the voluntary after-tax solo 401k bucket. You would make the voluntary after-tax solo 401k contribution to this voluntary after-tax solo 401k bucket, so brokerage account at Fidelity, and then you would immediately convert it to the Roth solo 401k bucket. Then we would need to collect information from you so that we issue the Form 1099-R to report that conversion to the IRS. So again, here's a good slide here. So you make the voluntary after-tax solo 401k contribution to this designated account, aka the voluntary after-tax solo 401k brokerage account. You then make the contribution to that voluntary after-tax solo 401k bucket, aka Fidelity brokerage account. You then convert it to the Roth solo 401k bucket, aka Roth solo 401k brokerage account. Then you need to complete our online conversion form so that we collect the necessary information to issue the Form 1099-R to the IRS to report that conversion. So I shared the link with you where we did a full webinar step by step on how to do that. So take a look at that link there. Okay, let's see what other questions we have here. Let's see. Looks like we got a question here from Brian Murphy. And I think this is regarding how to report contributions on your tax return that you make to a solo 401k. And as I mentioned earlier, we actually have a page on our website with step-by-step instructions on how to report those contributions on your tax return. So let me share that link with you so you can take a look at that. Here's the link So take a look at that link there. We have images that tell you exactly on what line to report those contributions. But let me look at your question here some more. So my question is about employee contributions. I have an S Corp and paid myself as both an employee and business owner. That's exactly right. Contributions to the solo 401k plan when you're self-employed business as an S corporation are going to be based on your W-2 wages. It's going to be based on box 1 of your W-2 wages. Both the employee contribution and the employer contribution are going to be based on your W-2 wages. So you need to make sure you have enough W-2 wages from your self-employed S corporation business to be able to support both the employee and the employer contribution amount. So you made a 23,000 employee contribution. It looks like that was for 2024, entirely out of my S corp payroll. So that means you made it based on your W-2 wages. Your question is, do I include that 23,000 employee contribution on the W-2 or on my Form 1040 Schedule 1? Great question. Let me pull up my cheat sheet here. I shared that link with you earlier. Let's go back to that link so you can see what I'm going to be looking at. So there's the link there that we're going to be looking at. That page there gives you step-by-step instructions. So I'm going to scroll down to the S Corporation. Let me see if I can share this page with you as well. Give me a moment here. Give me a moment while I share that screen. Okay, hopefully you can see this. So again, this is the page here that I shared a link to. How are solo 401k contributions accounted and reported? And we have it broken down per entity. So let's take a look at yours. Yours is an S corporation. So we're going to scroll down here. Here it is. And you're asking about reporting employee contributions for an S corporation. Let's scroll down here. So not the employer, but we're looking at for pre-tax. So here we go. See if I can make this a little bigger for you. For both S Corp or C Corp, employee pre-tax contributions are reported on Schedule 1, line 16. So there's your answer. It goes further on to say, alternatively, employee pre-tax contributions may be reported in box 12 of the Form W-2. In short, you get to choose. Whatever you do, don't report it in both places because you're going to get double credit. So either report it on Schedule 1, line 16, which is an attachment to your Form 1040, or on box 12 of your W-2. All right, again, take a look at that page. As that page, let me see if I can, as that page does a good job of, how do I get this page? It does a good job of breaking it down for each entity type. Give me a moment here. Okay, so great question. Give me a moment here while I get my slides back on stage here. Okay, there we are. So hopefully that answers your question. You're saying, thank you. This is very helpful. My confusion was that, well, if the employer doesn't know about the 23 employee contribution, why should it report on the W-2 at all? Well, again, number one, there's more than one way to skin a cat, right? Number two, you get to choose where to report them. And typically your CPA should know where to report contributions on the W-2. But again, you get to choose whether to report them on the W-2 or on that Schedule 1. All right, so let's see if we have any other questions, and then we'll come back and pick up where we left off. Again, please subscribe to our YouTube channel. Please like today's video to help get the word out to other solopreneurs like yourself. And today's topic is, why is a Mega Backdoor Roth better than a Backdoor Roth IRA? We've been talking about this topic here for about 40 minutes now, so good stuff. Go ahead and type over your questions during the daily webinar. We'll pause and ask and answer those questions as they come in. Okay, let's see here. Um, Are there any pitfalls or exceptions for tax-free growth and backdoor? We've been talking about that, but we're going to keep talking about pitfalls to avoid as well. So good question. Okay, let's get back to our topic here. Get back to the slide here I wanted to go over. So we stopped at this slide here. We've been talking about the differences between a backdoor Roth IRA and a Mega Backdoor Roth solo 401k. Keep in mind that you can also perform a Mega Backdoor Roth 401k through your daytime employer 401k if your daytime employer 401k allows for the Mega Backdoor Roth. So when you hear Mega Backdoor Roth, that's another way of saying Mega Backdoor Roth Solo 401k and Mega Backdoor Roth 401k. Mega Backdoor Roth Solo 401k applies to owner-only solo 401k plans, whereas Mega Backdoor Roth 401k applies to full-time employer plans. It's still the same strategy. It's still the same regulations. You just have to make sure that the plan that you utilize allows for it. A lot of daytime employers who offer a traditional 401k have made a decision to not allow for the Mega Backdoor Roth 401k strategy. Same is true for a lot of solo 401k providers. They've made a decision to not allow for the Mega Backdoor Roth solo 401k strategy. So make sure you utilize a solo 401k plan provider like my solo 401k Financial, who does provide a plan with the Mega Backdoor Roth solo 401k strategy. But further to that, make sure that the solo 401k provider that you utilize will do the reporting for that Mega Backdoor Roth solo 401k strategy. I know of many solo 401k providers out there that do allow for it, but guess what? They don't finish the job. They make you work with your CPA in reporting the conversion on a 1099-R of that Mega Backdoor Roth solo 401k strategy. And the conversion of the Mega Backdoor Roth solo 401k strategy has to be done on both a Form 1099-R and a Form 1096. It's a two-step process. So make sure that the solo 401k provider you utilize for the Mega Backdoor Roth solo 401k strategy will finish the job. A company like my solo 401k Financial is such a company, and we were actually the first ones in the industry. Yes, you heard that right, in the industry, to provide the Mega Backdoor Roth solo 401k strategy, starting all the way back in tax year 2013, when it really became popular, when it really started. So make sure that you utilize a provider that will do that for you. Okay, so the differences. We've been talking about the differences. Let's continue talking about that. So a backdoor Roth IRA is designated for individuals with incomes exceeding the limits for their Roth IRA contributions. That's the modified adjusted gross income. If your modified adjusted gross income is over a certain dollar limit, you cannot make Roth IRA contributions. It's worth noting that that does not apply to the Mega Backdoor Roth Solo 401k plan. In other words, the income limits don't apply. That's a question we oftentimes get. Individuals have done backdoor Roth IRAs in the past, and they try to apply the backdoor Roth IRA rules to the Mega Backdoor Roth Solo 401k strategy. It's like talking apples and oranges. So again, the backdoor Roth IRA requires making a non-deductible IRA contribution and then converting it to the Roth IRA, and therefore it's subject to the pro rata rule. We talked about that at great length already. Now, the Mega Backdoor Roth Solo 401k utilizes voluntary after-tax contributions within the Solo 401k plan, which are then converted to the Roth Solo 401k via an in-plan conversion or to the Roth IRA. And they're not subject to the pro rata rule. Why are solo 401k plans or any 401k for that matter not subject to the pro rata rule like IRAs are? It's for one simple reason. And if I had a dollar for how many times I've had to explain this to CPAs and attorneys since 2013, I'd probably be a millionaire, maybe even a billionaire. That's because a 401k, including a solo 401k, is a defined contribution plan, which means that you have to separately track each contribution source within the plan by having separate buckets, aka bank or brokerage accounts. You've got a pre-tax bucket, a Roth solo 401k bucket, and a voluntary after-tax solo 401k bucket. When a voluntary after-tax solo 401k contribution is made, it doesn't go to the pre-tax bucket. It doesn't go to the Roth bucket. It goes to the voluntary after-tax solo 401k bucket. So that's why that pro rata rule does not apply. You then convert that to the Roth solo 401k or the Roth IRA. So again, I'll probably get that question again here I probably get that question every day. But hopefully this webinar will help shed light on that and help spread the word about how the pro rata rule does not apply to the Mega Backdoor Roth Solo 401k. I've even seen some forums out there, whether it's Bigger Pockets, whether it's the Oblivious Investor, whether it's all those other ones where you've got CPAs and attorneys trying to say that the pro rata rule applies to the Mega Backdoor Roth Solo 401k. Well, it does not. That applies to to backdoor Roth IRAs, not to the Mega Backdoor Roth Solo 401k or the Mega Backdoor Roth 401k strategy. So please help spread the word. There's a lot of miscommunication out there, especially in a lot of these forum posts out there. Whether it's Reddit, that's another one that has a lot of bad information about the Mega Backdoor Roth strategy. The Oblivious Investor is really bad at it. Bigger Pockets as well. So please help spread the word. Okay, so let's see here. Let's go back here to, looks like we have some more questions here. We'll look at those questions in a moment here, but let's finish up this slide here. So again, the Mega Backdoor Roth Solo 401k versus the Backdoor Roth IRA is a lot better. Why? For all the reasons we've mentioned. And also the fact that you can contribute a lot more to the Mega Backdoor Roth Solo 401k by making a voluntary after-tax solo 401k contribution, which you can contribute the entire overall limit for the year, which is $70,000 for tax year 2025. That can be contributed to the voluntary after-tax solo 401k bucket. And then you can turn around and convert that directly to that Roth solo 401k bucket. So you make it to this bucket, then convert it to this bucket. Or if you want to convert it to a Roth IRA instead of the Roth solo 401k, you would convert it to an outside Roth IRA, whether an existing Roth IRA or a new Roth IRA. Okay, let's take a look at some more questions here, and then we'll continue with today's exciting topic, which is why is a Mega Backdoor Roth better than a Backdoor Roth IRA? So, looks like we've got a question here by Modern Day Debate. Wonder if that's a forum provider. Okay, for the amount I can put into my Mega Backdoor Roth each year, if my total wages steps other than compensation box one were 43,000, is the maximum amount I can shove into my Mega Backdoor Roth? Great question. So if you're self-employed business is taxed as an S corporation, then contributions to the solo 401k plan, including the voluntary after-tax solo 401k contributions as part of the Mega Backdoor Roth solo 401k strategy, are going to be based on your W-2 wages from your S corporation. Therefore, if you're trying to maximize the Mega Backdoor Roth Solo 401k strategy for tax year 2025, for example, you're going to need to pay yourself at least $70,000 of Box 1 W-2 wages. You will then be able to contribute that entire $70,000 to the voluntary after-tax solo 401k bucket and then convert it to the Roth solo 401k or the Roth IRA. So you got to have the required earned income from self-employment income in order to make any type of solo 401k contribution, including utilizing the Mega Backdoor Roth solo 401k strategy. So if you only report $43,000 of W-2 wages from your S corporation, the maximum you're going to be able to contribute is $43,000 as part of the Mega Backdoor Roth solo 401k strategy, and you will not be able to make any other contribution to the solo 401k plan. Therefore, you will not be able to make any pre-tax solo 401k contributions or any Roth solo 401k contributions because you will have exhausted the maximum that can be made to the voluntary after-tax solo 401k by putting that entire $43,000 to the voluntary after-tax solo 401k bucket and then converting it to the Roth solo 401k or the Roth IRA. Does the 70K limit apply to the sum of the pre-tax and the backdoor Roth? Yes, it does. And I just answered that question. It looks like you may have typed out while I was answering that question. Great questions. Okay. Again, please like today's video. Please subscribe to our YouTube channel to help get the word out to other solopreneurs like yourself. In the meantime, let's continue with today's presentation. Let's get to the slide that we're at here. We went over this one already, that one, this one. Who can use the Mega Backdoor Roth Solo 401k strategy? Well, self-employed individuals with earned income. So in order to open a solo 401k plan, you have to be self-employed and not employ any full-time non-owner W-2 employees in your business unless they're under age 21, because you can exclude those who are under age 21 from participating in a solo 401k plan regardless of their age. Regardless of their hours worked, as long as they're under age 21. So high earners will benefit from the Mega Backdoor Roth Solo 401k strategy because Roth Solo 401k plans as part of the Mega Backdoor Roth Solo 401k are not subject to the modified adjusted gross income. So you can be a high income earner. We talked about business owners, freelancers, and consultants. So to open a solo 401k plan, as long as you're self-employed and are reporting earned self-employment income and don't employ any full-time W-2 employees who are not owners, you can open a solo 401k plan, whether you're a sole proprietorship, partnership, or you have your own self-employed S corporation, or even if you're a farmer and file Schedule F, or a consultant where you file Schedule C. All right, but as a matter of fact, why can't you do both? Utilize the Mega Backdoor Roth as well as the Backdoor Roth. You actually can. That's one of the great things about the Mega Backdoor Roth Solo 401k strategy and the Backdoor Roth, and the Backdoor Roth IRA strategy is that you can actually do both. Obviously, the Mega Backdoor Roth Solo 401k is a little easier to do for the reasons I've already mentioned for the past 40 minutes. But if you want to do both, you certainly can. So we've talked about the key requirements for doing the Mega Backdoor Roth Solo 401k. You have to be self-employed. You have to have earned income from self-employment activity. You cannot employ any non-owner full-time W-2 employees if you're looking to open a solo 401k plan. There's also the part-time employee rule that applies to those that have a solo 401k plan already, where if you employ a W-2 employee who works between 500 and 999 hours for 2 consecutive years, then that's going to result in you no longer qualifying for a solo 401k. But that's a whole other topic. Okay, so again, you can have both the Backdoor Roth IRA and the Mega Backdoor Roth solo 401k. So with the backdoor Roth IRA, again, you can open one and make non-deductible IRA contributions, and you can base the contributions to the non-deductible IRA on your W-2 wages, whether it's your W-2 wages from your self-employed business, whether it's a sole proprietorship, S corp, or from your daytime job. So to make non-deductible IRA contributions, you don't have to be a self-employed person. You can be working for your full-time employer, and you'll get W-2 wages, and you can make after-tax IRA contributions and convert them to the Roth IRA. So, for example, let's say I don't think I have an example here, but I'm going to give you one. Looks like we have an example here. Here we go. Example one, the high-earning consultant. So let's say the consultant is under age 50. Let's say the consultant's name is Mike. So Mike makes 150,000 of self-employment income, and then he also works part-time at his W-2 job. So not only is he self-employed, but he also works at a full-time employer where he's not the owner of that business, but he's a W-2 employee of the business. So here's the strategy. He can utilize the backdoor Roth IRA strategy. He can make a $7,000 contribution to his traditional IRA and then turn around and convert that to the Roth IRA. Again, don't forget about the pro rata rule that applies to the backdoor Roth IRA. We've already talked about that, so be mindful of that. And then you can also utilize the Mega Backdoor Roth Solo 401k because he's self-employed. So let's say Mike is self-employed. So not only does Mike work for a full-time employer, but Mike is also self-employed and as an S corp, and he receives W-2 wages from his self-employed S corporation. If he has enough self-employment income from that S corporation, he can contribute the overall limit of $70,000, which is the amount for 2025. And then he can turn around and convert that to the Roth Solo 401k. So now he's saved a total of $70,000 indirectly in Roth funds, $7,000 through the backdoor Roth IRA strategy, and $70,000 through the Mega Backdoor Roth strategy. Let's go over example two. Let's say Mike is over age 50. So, and he has 100,000 of W-2 wages from his own company. Let's say that it's a S corp, self-employed business. So he's going to be able to utilize the backdoor Roth IRA. He can do since he's over age 50, he can do an $8,000 contribution to his after-tax IRA and then convert it to the Roth IRA. So that extra $1,000 is the catch-up amount. So for tax year 2025, an IRA has a catch-up amount of $1,000 for those who are age 50 or older. Now for the solo 401k, he could do pre-tax contribution of $31,000 or as a Roth solo 401k contribution. And that's made up of $23,500 employee contribution plus the $7,500 catch-up amount. Because remember, and don't confuse this, catch-up contributions for a solo 401k plan can never be utilized for the Mega Backdoor Roth strategy. In other words, they can never be made as a voluntary after-tax solo 401k contribution. That's different than the backdoor Roth IRA, where the catch-up amount for those who are age 50 or older can go to the after-tax IRA and be converted to the Roth IRA. Don't apply those same rules to the solo 401k. As I discussed earlier, when doing the backdoor Roth IRA and the Mega Backdoor Roth solo 401k, don't mix the rules. Don't apply those backdoor Roth IRA regulations to the Mega Backdoor Roth strategy, nor apply the Roth IRA contribution rules to the Roth solo 401k. Again, there are a lot of forums out there, from Bigger Pockets to the Oblivious Investor to Reddit, that are full of so much misinformation. You got these individuals out there taking their experts and they start mixing the information. So be mindful of that. So again, the catch-up contribution can never, for a solo 401k, can never be utilized for the Mega Backdoor Roth strategy. That always has to be made to the Roth solo 401k starting on January 1st of 2026. All catch-up contributions to a solo 401k have to be made to the Roth solo 401k as well. For tax year 2025, you can still make those catch-up contributions to the pre-tax solo 401k or to the Roth solo 401k bucket, but starting next year on January 1st of 2026, you're going to have to make them to the Roth solo 401k, or if you have a full-time employer 401k that allows for catch-up contributions, they're going to have to go to the Roth 401k bucket as well. So this will result in the Mega Backdoor Roth solo 401k, where you make $46,500 voluntary after-tax solo 401k contribution. And then you convert that to the Roth solo 401k or the Roth IRA, resulting in contributing $77,500 in total for tax year 2025. So we had an individual ask earlier about common pitfalls. This slide here is going to cover that. We'll go over that in just a moment. Does your website provide calculation for contributions? Yes, it does. And also visit our video catalog, where we've done webinars where we talk about how to do a contribution for each entity type as well as each source type. So not only do we have a calculator, we've also done webinars on this topic. So go ahead and visit our YouTube channel so you can see those step-by-step instructions. Give me a moment here and I'll share our calculator with you. Let me dig it up here. Give me a moment. There it is. Okay, take a look at that link there. Meanwhile, let's talk about common mistakes to avoid. Again, today's topic is, why is a Mega Backdoor Roth better than a Backdoor Roth IRA? So common mistakes to avoid: not having adequate income. So again, in order to contribute to a Roth, to a Roth IRA or a non-deductible IRA or a solo 401k, whether pre-tax contributions, Roth contributions, or voluntary after-tax contributions, you have to have enough earned income to support that contribution. Remember that the pro rata rule applies to the Backdoor Roth IRA strategy. It doesn't apply to the Mega Backdoor Roth solo 401k strategy, and we've covered that already as to why. Also, missing deadlines. The contribution deadlines are different for IRAs versus solo 401k plans. Inadequate record keeping. And that can be done very easily for the Mega Backdoor Roth solo 401k. Because again, with the Mega Backdoor Roth solo 401k, you are required to have separate holding accounts for each source type. And that's going to be handled by having separate brokerage accounts. So if you utilize the solo 401k from my solo 401k financial that allows for the Mega Backdoor Roth strategy, we allow you to choose where you want to hold your funds at. At the end of the day, it's your money, so you should decide where to hold the money at. So if you decide to use Fidelity, for example, to hold the solo 401k funds, we'll help you open up 3 brokerage accounts at Fidelity to hold the separate fund sources under the plan: the pre-tax funds, the Roth solo 401k funds, and the voluntary after-tax solo 401k funds, because you are required to have separate sources, separate brokerage accounts for each source. Go back to that prior slide here. So again, we're talking about common mistakes to avoid. So you want to make sure you work with an experienced solo 401k provider when utilizing the Mega Backdoor Roth solo 401k strategy. And I already talked at great length about that earlier as to why. Okay, let's see here. So we talked about the pro rata rule already. I think we've pretty much hit that over the head quite a bit. So take a look at that here. Okay, let's see here. We talked about this slide already, the pro rata rule. Take a look at that slide again. I think we've come to the end of our session. It's been a long session. We've been on for about an hour now. Okay, so there you have it. Again, thank you for joining today's daily webinar. We'll be live again here in a couple hours. We'll be back again tomorrow. Until next time, have a great day.